Greetings. This is Dr. Jeffrey Scott. This is my weekend market update for July 4th, 2022. Will the holiday rally fizzle and fail, kind of like a bad sparkler? Again, my name is Jeffrey Scott, and my email address, as you can see here, is hgsidoc@gmail.com. If you are new to the channel, I do not keep a mailing list, but if you hit the subscribe button and the alarm, you should be noticed when I post these. I post on YouTube over the weekend this relatively long video, which usually runs between 30 and 50 minutes. During the week, I post elsewhere, which I'll talk about in a few moments. If you like this, hit the up thumb. If you don't, the down thumb. And I'm always open to constructive and sometimes deconstructive criticism about how I can make this better for people. Everybody starts with a disclaimer. I'm no different. This is purely for education. Anything I recommend is in the spirit of education, not investment advice. I am a doctor, not a broker. Tools demonstrated those I use in my daily trading. I've paid for all the tools I use. And trading involves risk, and you alone are solely responsible for any investment decisions you make. If you can do me a favor, I'd love to see you at the Wealth 365 event. I don't ask for much. I don't charge for these. And when I do live education like we did 2 weeks ago in Orange County, I don't even cover my travel costs. But if you want to help me out, this is the URL for the Wealth 365 event. I love these things. This is how I got first involved in the wealth charts community. I went to a couple of these. I became a founding annual member on wealth charts, which, by the way, the cheapest time of the year to buy it is during these events. And then I bought a couple of packages, started talking with Rob Hoffman. The next thing you know, I'm a speaker, and my stuff is built into the program. Pretty darn cool, if you ask me. I had to put an X on the 8 because now it's closer to 7 days and probably 6 days and 20 hours because it starts, I believe, 9 o'clock in the morning on Monday the 11th. So I hope to see you there. And if I don't scare you away with these videos, I do post a daily video on stocksanddocs.com where I do a little bit of education on Sunday. During the week on stocksanddocs.com, it's probably a 5 to 7 minute video. And I've had some great picks, if I say so myself, but it's not really about picking stocks. It's about following the same approach to the market, 5 to 7 minutes long, unless there's a change in the market, and coming up with a couple of ideas to follow the next day. Again, education only, more how do you use a tool rather than what stock to buy. So that's the opening statement, and let's get rid of the PowerPoint. Now, I used to sit and go through a bunch of programs to take a look at the market, and then I kind of realized that that slowed me down. So now I take the important screenshots that I like and I put them into a spreadsheet. I can save that spreadsheet, which I do week on and week out. I may actually start sharing it. But it gives me a chance to go quickly through the same review on a weekly basis. So first sheet up here on the upper left-hand corner, these are the major market indexes, indices, I guess is the right word. And I always start by looking at percent from the 52-week high. Notice in red, the big losers are things like FANG, IBD 50 ETF, and the ARC Innovation. So small and large cap growth have really done poorly, and they've not hit a new high in almost, well, a trading year and longer on the ARC funds. Bitcoin actually has led to the downside, 77% off their all-time high. Now, if we go back up here, we can see that the larger cap stocks, the Dow, the NYSE, and S&P are down between 16 and 21 on the S&P. So this is not a strong market. This is a horribly weak market and has been so for a long time. The only things that are at all near their 52-week highs in the last month are dollar, oil, and commodities. Probably doesn't reflect great on the major indexes when that's what's leading. Now over here, it's days since the 52-week low, and notice that the IBD 50 ETF, which is an actively managed ETF reflecting the components of the IBD 50. So by being managed, it's updated on a regular basis as different stocks come in. And I am not at all cutting down this list. It's a great list during growth influenced bull markets, but it's at its 52-week low. I won't say all-time low. So small cap growth clearly has not been working. Bitcoin is 1 day off of its 52-week low. And you could see that the smaller caps and NASDAQ are 3 weeks off the lows, and you see about 5%, as are the larger caps, also about 5% off their lows. I learned a lot on this sheet. If I look at what's worked on the last 5 days, dollar, oil, the VIX, the TLT bonds, and biotech. So the only equity related index in that list is biotech. It just tells you, gives you an example of how underperforming this market has been. Now, over 5 days, it was a little bit better. You could see 1 to 2% on the large caps, 2 to 4% on the small caps. And that was driven, much of that, and this is, by the way, down negative. And that was driven by early in the week, because you could see on Friday we actually had a better return. So interesting markets, not a very bullish environment. If we look at the sectors, we could see that the losers of the 52 weeks, communications, discretionary, and technology. And then right above technology is financials. It's hard for me to imagine a market that's going to do well when it's led by things like utilities, which are down only 7%. Healthcare down 9.6 is good for a leader, and staples down only 10. When technology and financial and discretionary are leading to the downside, you are talking about a bad market. Now, one of the tools I use for the ebb and flow is looking at the Woody indicator in deference to, or respect to, Ian Woodward. And when this is red, it's a market to be short. When it's green, it's a market to be long, or to consider being long. And when it's back and forth, it's chop. And if you just look at it going back since November, we're used to seeing months in a row of green or red in the Woody indicator. And what we're doing is we're just going back and forth between chop, bad, good, chop, bad, good. And that's why it's been so hard to make money in the market. And the other thing is this brown and yellow here, if you go back 2 years, you didn't see that. You saw some in November as the market was peaking. This is just showing how volatile this market is, and part of why this market has been challenging. On the Woody indicator, on the sectors, it's interesting. They've all turned green here, and driven by the last couple of weeks of this small market rally, bear market rally. But like the major markets, you've not seen persistency on anything in either green or red, which is partly why it's so hard to make money on any long-term duration instruments in this current market. If we look at the Q tools, just to look at what happened in the market, on Friday, 91% of the sectors were up, 86 of the industries, and 80 of the stocks. So if you're still long, you probably had a good Friday. If you look here at the buckets, we're 42% above the midline at S&P 1500, or the Bollinger Bands, 58% below, and we'll come back to that. That's bearish slightly, but not horribly. And then the number of stocks below their buckets or above is nominal. When we look at the 5-day market, you see a big piece of red compared to the last two. So Thursday and Friday showed some improvement in the market, mostly on Friday. Friday was able to mitigate some of the weakness on Thursday and turn the 2-day into green. And if you look back at 10 days, it looks better, and a month, it looks worse. What does that look to me like? A market that doesn't know what direction it's going, and it's hard to be committed except for very short-term trades. The warehouse report, here we're taking all the stocks in the market, looking at their ERG, their earnings per share rank, their relative strength, and their group rank. And this would be based upon the prior Friday close, which I guess was the 25th. And then I run prospectively what happened between that day and the next weekend, and how did it perform based upon ERG. So really not much here, no curve that's meaningful. Down here it shows that EPS rank, didn't really make a difference. You did poorly on the week no matter what. Now, high relative strength stocks had less negative than poor relative strength. Stocks that went in a good group had better performance than prior bad group, but really not much here. This is a sheet that I use that gives me a great insight into the market. And I look at several different things. One thing I look at is, and probably the first thing that I look at is this red line. We'll talk about this on my Wednesday the 13th presentation on at the Wealth 365. But more often than not, my bacon has been saved by this thing called the bongo, which among others I developed about 15 years ago. And the weekly bongo is a fantastic long-term trending indicator. And if you go long when the weekly bongo is red, whether it's on your index, your industry group, your individual stock, you are going in a counter trend move, and counter trend moves by definition are short and often fraught with failure. So we have been in a red, frankly, going all the way back to December on this chart. Now, what else do I like here? The Bingo, Eureka, Phoenix, and Kahuna we'll talk about again on Wednesday and Saturday at the Wealth 365 event, but these are some of the signals that I look for a market that's turned around, and we see none of them are down here. I look at the percentage of new lows, which continues to be a problem, despite the fact the last 2 days the market looked okay. And we can look at the percentage of new highs, telling me there's not many buyers. So I just learned a lot about this market by just this chart. And here is just looking at over time on a weekly basis what the NASDAQ has done. And then down here, I just want to point out a couple of things. One, here's the bongo. And then these red lines here are what's called the Hindenburg Omen. And that's kind of the intent of this worksheet, is to keep me aware of the presence of a Hindenburg signal, because there's not been a market correction since ever that wasn't preceded by a Hindenburg Omen, a major correction. And the problem with the Hindi, like many other things, is when they're right, but often they don't lead to much of anything. So you often see just a small pullback. But if you don't believe in them, you can look in November, December. We saw multiple Hindis fire, and the market has been falling ever since. This is the NASDAQ. Now, the NYSE looks a bit different. No, it's still got the weekly bongo. But notice that intermittently it had some less new lows. But the important thing you can see here in April, after one of the failed bear market rallies, we actually had the Hindenburgs fire on the NASDAQ. And then on the NYSE, and then the market went lower. Still very bearish. Nothing here that says go long, go long, go long. Still a market where a long trade is a counter trend. Now, 2 weeks ago, was it 2 weeks ago? Yeah, about 2 weeks ago, when I was sitting in Southern California, I put this picture up and I said this is a market that's going to bounce. And why? Because when I see 96% of the stocks in the S&P 500 below the 1500 rather, below the midline of their Bollinger Bands, I know that we've gotten probably too bearish. And when I start to see 20 or 30% of the stocks below the lower bands, it's sort of a reversion to the mean that you're going to see the market move up. Now, we were correct. We just didn't get much of a bounce. And if you look at a week ago, we were at 65 below, now at 57 below. Really not much has changed over the past week of trading, but it's much different than it was 2 weeks ago. Energy on the week, although you could see on the daily, had a good day for oil, natural gas, and gasoline. When you look at the current month, if you're still holding a lot of energy stocks, and I'm not saying that that's a bad idea, because I'm not, we could see oil continue to go higher. You can see over the month, natural gas has gotten pummeled, oil's down, coal's down. If I look at some of the metals, you'll see a similar pattern on the month, where look at gold and silver, I'd almost give them flat compared to the others. So at least gold, silver's down 10. But look at Dr. Copper, down over 20%, iron ore down 17.4%, platinum down 13%, and HRC steel down 19.83%. So it's been a tough month for some of the metals. Now, earlier this year, I was holding a lot of dry shipping stocks, thinking of Zim, Starbulk, Golden Ocean. And I don't have any of them now. And if you want to know why, it's because of this chart here, which is the Baltic Dry Index, which you can create using the ticker BDI in TradingView. And notice that we had a massive move up this year, and when it pulled back to the trend line, it reversed trend line and it broke. trend line and it failed, and therefore you had to get out of dry bulk shipping stocks at this point when it turned over here. So no time to be in dry bulk shipping stocks. Interest rates, well, these are always interesting, aren't they? 10-year came down, 30-year came down. We know that. It's interesting. Inflation's worse, yet rates are falling. What does that tell us about the coming economy? Maybe this chart should tell you something. I call this the scariest chart of the weekend. Credit is tightening. How do I know that? Personal friends having difficulty getting mortgages when they have plenty of income and no debt. Hearing from various companies that I visit either as an investor or as potential vendor and hearing about how difficult it is to raise money. And then this is the Fed option adjusted credit spread. And when this starts to go up, that's a bad sign, in my opinion, for the economy. So if you just look to the left, you could see here's what happened in the middle of January, February 2020. This started to spike. That was a clue preceding the market crash. This is what happened in the end of 2018, 2019. And you could see what happened in 2018, 2019. And then here is what's happening right now is we've set we've taken out the 2018, 2019 peaks. We're still well off the 2020 peaks, but that's a very, very worrisome chart. The issue here about yield curve inversion, yeah, we've got a recession the next 6 months to 2 years. Well, we already know that. It might be here already. It depends who you listen to or talk to. Overbought, oversold, showed some improvement. Stocks above the 200, stocks above the 40, both improved. Yet on the very short term, T2121, 13-week new high, new low, gave back some. Now again, if I go back to that live meeting, we were sitting on this line here, and I said this is a great tool for looking at reversals. Well, we reversed, but it doesn't mean we can't come right back down. Economic news, there's quite a bit this week. Obviously today, Monday, the market's closed. We got some factory orders tomorrow. On Wednesday, we got some PMI, job openings and quits. And then we have this thing called the FOMC minutes, where we might get a clue as to what was below the surface of the Fed comment. Is there more interest in tightening than perhaps was given out at the meeting? Don't know. We'll find out from the minutes. Then Thursday, we got jobless claims. We've got 2 Fed speakers on Thursday. And then Friday, my good friend John Person likes to call it the monthly unenjoyment report, some inventories and consumer credit. So pretty busy news week. Not a very busy earnings week. Not surprising till end of the quarter, getting ready for Q3, but also holiday shortened week. The expected moves are pretty fantastic of what's going on here to me. First, you got to realize what these are. The expected moves are, let's say you think there's going to be a really big move this week in the NASDAQ, and particularly the NASDAQ futures. And you call up your broker. Oh, we don't do that anymore, do we? You go online and say, I know the NASDAQ's going to move a ton this week. I just don't know if it's going up or if it's going down, but I know it's going to move. So I'm going to buy a straddle at the money. So if we look at the NASDAQ and we see where it closed on Friday, notice this gray line is where it closed. So you're going to buy a straddle at somewhere around 1727. I don't know if it's 1725, 1730, you're going to look at that. And that straddle means you're going to buy long a call and long a put. So that means you're going to have a double premium, but you're expecting a massive move. So let's say that you take that long call, the cost of that long call at the money, the cost of that long put at the money, and you add them together. And if you add it to this point, this is what you have to go beyond to make money to the long side, and you have to go below this to make money on the short side. Now, who are you buying that straddle from? You're buying that straddle from a options market maker, who, by the way, are by far the smartest money in the stock market. So you are buying from the smart money, And what does the smart money like to do? Oh yeah, they like to win. So if I go back in time, I find about 80 to 83% of the time in recent era, the stock will close in between the green and the red. Well, if you had to get above the green or below the red to break even, that would mean you lose money if it doesn't get beyond there. So if 80 to 83% of the time the stock closes, or the index or whatever the target is closes within the green and the red, it means that the market makers win. And the further it is towards the gray line, the more that they win. So what was unusual? Let's go back this past week. The market traded down on Tuesday, another deep down day on Thursday with a nice recovery. And then on Friday, we traded up and got back within the expected move. So that means on this day at least, the market makers made a little bit of money. They didn't make much because we're right near that red line. Okay. Now, what happened on the prior week? Closed way above, so the market makers lost. What happened to the prior week to that? It closed way below. The market makers lost. What happened to the week before that? It closed way below. The market makers lost. Then we had a flat week here, and the week before that, they closed way above. So that means 4 out of 5, 4 out of 6 times the price closed outside the green or the red bar, meaning the option makers, which usually win, ended up losing. That just tells you how crazy this market is, because if 83% of the time the market makers win, and 4 out of 6 times on the E-minis of the last 6 weeks they've lost, that just tells you that this market is not a normal market. So that was the E-minis. The NASDAQ similar, but closed well below. Great reversal day on Friday, no question about it on the NQs, but still closed below the red line. The Dow got back into it on a strong reversal day, as did the Russell. The VIX, despite all the negativity and despite even the NASDAQ closing below the red line, the VIX didn't move much on the week and closed down on the week, and that really has a lot of people scratching their heads. Now, I'll tell you, the VIX level is much higher than it was a year ago and 2 years ago. But one way we're going to see this bear market die is likely going to be a spike in the VIX, and we're not seeing it there. And then you got the dollar, and the dollar closed in the range, but had a strong week, was actually outside the range part of Friday. So my thoughts. First day of July was a good one for the stock market, still not enough to save it on the week. We have just finished the worst half of the year for the S&P 500 since 1970. Usual concerns spooked the markets. Lack of earnings growth, inflation, and rate hikes. Semis were weak. Clearly defensive. Utilities, healthcare, staples leading. Energy rebounded, and stocks dropped 9.6%. I showed you the yields dropped as the Fed cut forward GDP. Consumer confidence missed, and inflation continued to run hot. Stagflation, anybody? We are in a bear market. That means we need to be protecting our money. I think the markets have signaled that we should be defensive. Markets are closed today, and we have monthly employment on Friday. We have some Fed speeches in the June minutes, so there could be a lot of news play. If you feel the need to play small with a short leash. Some things are working. Biotech, we've talked about that since the ASCO meeting in early June, and most of the picks I gave at that time, Legend Biotech, for example, Genmab is another that we talked about. CTIC is one that we talked about. And then some of the big pharmas that I mentioned over the last weeks, Lilly, Bristol Myers Squibb, those have all done very well. But these are counter-trend rallies if you look at the market. Even biotechs way off their old highs have lots of overhead supply. Remember, cash is a position. And the key is when this market turns, and it will turn, and when it turns, you'll have a chance to make a lot of money if you're long. You got to have cash left. So raise cash. If you feel the market's going lower, which I do, then look at contra ETFs as a way to play the market, shorting individual stocks. I like the contra ETFs, and frankly, I like options on them because I can control my risk. So that's my thoughts on the market. And just to be another shameless plug, please join me. The program is the 11th to the 16th. Stop the video. Go and sign up right now using this link. I'll try to remember to post it in the YouTube remarks section as well. I guarantee you're going to like it. And then if you like this video but you want the non-teaching short version, just go to stocksanddocs.com and you'll find a fair number of videos that I've been posting now for the last several months. I post something every morning before the market opens or around the time the market opens. Now, to be fair, this is something I've been doing with Rob Hoffman of BecomeABetterTrader.com. And he's just been helping me build a library of content. And so I send the videos to his team. They make sure I haven't, the quality is okay from a sound perspective. They put the disclaimer on and they post them. I might record them late at night. I might record them right before the market opens. I don't really look at the futures because, frankly, they just give me bad information sometimes because of how they whipsaw it. I think you'll like these, especially if you're looking for similar content to what I'm doing here, but a lot shorter. All right, let's go and let's look at charts. And if you're new to me and you're going, gee, Merry Christmas, it's 26 minutes in, he hasn't looked at one active chart. I go, yep, because I looked at the market, and I think I've just defined what the market is. And I've got that one slide I love to use, and I'll be using it next week, which is, when the wind's at your back, you attack, and when the wind's in your face, it's a disgrace to keep going long. And I think I just should have convinced you the wind's still at your face, so be very careful. Let's take a look at the market. So let's look at the spiders here. And a couple of things I want to point out. We had a great run. If I go all the way back, which I'm not, to January 2020, this line here was the pre-market crash in 2020 high. And this is sort of my working hypothesis of where we are going to pull back to. This right here is the 2020 low. Now, just for the sake of grins, I won't say the other part of that. If we go from the high to where we are today, we'll go to the low here. We've had about a 25-26% correction on the spider. If we pull this down here and look at this line, that's a 42% correction, so another 15% waiting for us. And then if I pull this down here and go down to that low, that's a 50, that's about a 36% from here, or from the January 2020 high. I don't think we're coming down to the 217. I would think that this 337, 338 is going to be a huge buying point if we get there. You may think I'm nuts to think that that's a potential downside target. That's my downside target. And the other thing to point out, leg one, leg two, we're still in the third leg down. We have a lower high and a lower low. And until we break above a trend line, like right here, get above this 50, we're still in a downtrend and we're still in that third leg down. So it's hard for me not to be bearish. What is positive on this chart? This here is the daily bongos turn green. That's a short-term indicator. It will go green during every one of these bounces. But look at the weekly. The weekly has been red continuously. So this is a downtrend. Any long approaches here, again, counter trend trades fraught with failure. Here is the February 2020 highs at 243. That's about 40 points here, which is about 15% from our current level. So this is the Qs, and if I look at the Qs, what do I think? I think the same thing. I think that First leg down. Let's go into the weekly. Leg down, down, and we're just in the midst of our third week down, our third leg down on the weekly chart. So again, a tenuous at best. Yeah, on both of these, did we have green bars on Friday? We did. And could we rally up? Sure we could, but until we break above the prior high and have a higher high, we're in a downtrend to proven otherwise, and you got to be careful to the long side. What about the diamonds? Well, I think I said let's go back to March 20. No, I'm not going to do that. On the diamonds, here's that level. We actually came down and got close to it. We're up off of it now. But the diamonds are like everything else. The diamonds have to get a higher high here, or we're just in the middle of the third wave down. What about the Russell 2000? Notice they've already hit their January 2020 high, and they've hit it multiple times, and they're oscillating around it. So they haven't really broken far below it, but, you know, they're there. Does that mean the 2020 lows are in play? I sure hope not. Again, a positive day on Friday, which is good news for the bulls, but really they're all counter trend rallies right now. The VIX, as we talked about, didn't do much, and the dollar, which is not our friend, by the way. King dollar is bad for the market when it gets too powerful, and it's powerful, although it was weaker on Friday. Now, market theme, it's still large cap and value. And what does large cap value say to you? I should say defensive. And I look at this just to get a sense using the awesome, simple to do ratio charts and wealth charts to give me a sense of what's leading the market. What about the guppy charts? So if you've never been here, basically take a line chart of the ETF, and I'm looking at daily chart. Then I have every 25 between 50 and 250, a moving average, a simple moving average. And there's 3 or 4 phases. Phase number 1, market's in a strong uptrend. It's touching the 50, sometimes it's touching the 100 and bouncing. This is bull. Phase 2 is we start to get into choppy land and the market actually pulls into the indexes. Phase 3 to me is when we've broken below the longest moving average. And this is when you really got to be careful with your longs. And then phase 4 is when the market's moving averages start to roll over, which they've done. Now, once we get into phase 4, I've seen it take about a year to recover. Now, the market can go sideways. The market could go even higher. But it could be a year before we see an uptrend with the correct order of the moving averages. So we are clearly in phase 4. There is nothing bullish about the spiders, the diamonds, the Qs, and the Russell. And until we start to break into that moving average, which would be phase 2 going back up, and then above the moving average, which would be phase 3, and then above the moving averages with the moving averages reverting back to the positive, which would be a phase 4 in the bear market or the end of the bear market, you've got to be careful. So these tell me we're still in a world of hurt. Commodities. Gold had a great day, but it's bottom fishing. It's well below the 50 and the 200. It's about to have the 50 cross below the 200. Silver is just dead. Oil is having trouble holding the 50-day moving average. I'm not sure oil is dead. It would not shock me to see one more attempt at prior high, but we're getting to the part after 4th of July where oil starts to develop seasonal weakness. So that's one thing that we will be looking for. Now, David Elliott taught us about a thing called the ice hole failure, and what he basically said is if you break below a trend line or a moving average, and then you fail at that trend line, you pretty much, or moving average, go down to test the next one. And so you look at natural gas and had a very strong, almost vertical trend line. It broke through, it failed to take it, broke down, and came all the way to the 50, which did not hold. It had a couple of attempts at breaking back above the 50. It failed. It came all the way down, ice hole failure, to the 200. It's now trying to hold at the 200. This is natural gas. Imagine how much our inflation would be helped if oil does the same pattern. Not saying it will, just something I'm going to watch for. The 10-year, also like the dollar, you'd like to see it get weak. And it fell, gap down on Friday, and then closed with a bottoming tail. Now, I think we're at a point now where a weak 10-year in the setting of raising rates probably should have us worried, and maybe it tells us that this market is a lot weaker and the economy is weaker than we think, because that's sort of, to me, foretelling that there's market weakness coming and probably a recession. And I don't think that's news to you or me or anybody else, but I don't think it's necessarily bullish. If we look at the hourly sectors, this is what I'm looking at constantly during the day to get a sense of what's working and what's not. Well, I can tell you what's not is materials. All right, I'm looking for things pointing to the lower right-hand corner. Technology is not working. Those are the leaders to the downside. Leaders to the upside will be pointing to the right upper quadrant. That's staples, it's utilities, it's healthcare, and you're seeing a little bit of interest perhaps coming into real estate. So those are the leaders. The rest are in the middle. And just by looking at what's pointing up here, on a short term, I can tell you where the money's flowing, intraday or after the market is closed. All right, let's look at sector scanner. So I'm a top-down guy. We talked about how Friday was good, but the week as a whole was bad. So maybe we shouldn't look too much at the daily. Let's just go into the weekly. Utilities, industry, that's interesting. Financials, real estate, healthcare. It's an interesting list because that's a little different than we might have expected. But let's really just look at the algo, because I think that gives me a better picture. And it shows me utilities, energy, staples, and I'm going to go and I'm going to hit on healthcare. So even though it's got a negative algo, it's been leading. So I got my healthcare, my staples, and my utilities, and I added energy. This is the places where I'd be interested in fishing. If I hit compare, I'm going to bring up all the industry groups in those sectors. And if I go into daily, for example, let's just take the first top bunch. Let's go down to here. Hit the shift and then hit that. I've now captured those industry groups. And then maybe I want to look at the weekly as well and make sure I got the top weekly ones. So let's fill in any that we were missing. And I'll go down to, say, here. All right, so those are the top industry groups looking at daily and weekly algos. And if I hit compare, they're going to end up here. And then I could look at algo scores, for example, and let's take the top set of stocks down to, well, 700. And these are the ones on the daily. And then let's look over here at the weekly. And let's make sure we capture the ones that are up at the top that we might have missed. So I like to build a list of the good performing stocks in the market on the daily and the weekly, and then I'm going to drop them into a watch list. And I call this watch list my weekend review. And let's make sure that's when that's set up. The weekend review, awesome. And now I'm going to hit add to watch list, and these stocks are going to move into my watch list. You can see that happening up there. So I'm building a watch list every day of leading stocks, and that's where I like to fish from, because as a top-down guy, what's the market do? Well, the market's telling me to be careful. Let's be honest. But this is educational. Let's pretend the market was positive. So then I've looked at the bullish stocks, bullish industry groups rather, and I've taken the top stocks in those bullish groups, and then we're going to play with them in a few minutes. Let's go into Wealth Scanner. Wealth Scanner is a tool that you can put anything you want. I like putting a bunch of ETFs in and seeing what's working in the market. And let's make sure we've got, okay. And I've switched to a shorter term on this, although I'm more of a swing trader. So what's leading in the market at the end of the day? Friday, strong dollar. Yeah, well, never good for the market. Solar. Now, we have been talking about solar, and just for purposes of what I've been looking at, I've been talking about DQ ever since the live meeting 2 weeks ago. And I know some people took it at the live meeting. It was also in the video that weekend. Again, these are stocks I'm looking at, not guarantees by any means. And we've seen this one break out and have a nice run up with the group. Another one that looks good is JKS, Jinko Solar. So by doing this analysis, it would have called out the strength in solar. Then we have China. Well, a lot of these solar stocks are Chinese. Never good when a contra ETF is one of the strongest things in the market. And yeah, may have had a tough day on Friday, but you're in a very nice uptrend on short to triple Qs. Then pharma, biotech, healthcare, and then utilities, pharma. And we're now getting kind of low. So it's kind of that same thing. It's staples, utilities, healthcare, and then take it down a level, add in solar, pharma, and biotech. Let's go look at my CAT scanner. Now we'll be highlighting this on both Wednesday and Saturday, but Saturday really highlighting this because this is a tool that I find is extremely helpful for me to make money. So we're going to go down to that weekend review we just built. And I am going to rank the stocks, and I'm looking at longs. I'm doing this for education. I'm not saying go all in by any means. So what I've done is I've looked for stocks at least $5, 500,000 shares, greater than one bullish dot, and that's all I'm looking at here. And then I'm ranking them by the dots. If you haven't been here before and go, who's this idiot with the dots? The dots are just looking for conditions. Dot number 1, which would have been this dot right here, is looking at a big gap up. Dot number 2 is looking at lots of volume. Dot number 3 is looking at a breakout. And dot number 4 is looking for momentum. And there are indicators that I teach underneath the dots. But when I've looked at stocks for the last 25 years, and I go back and I look at my biggest winners and the best time to buy, there's always a dot associated with that time. So if some of the biggest winners are having their biggest moves and telling you to get in them when they have dots, why not just scan for stocks that have dots and cut the market down to size? And that's what I've done. And it also turns out, I think having more dots is better than less dots. So all I've done is taken that list from the weekend. I've ranked it by the number of dots, and you could do this bullish and bearish. And before I look at this, well, let's start with here, then I want to go to seasonality. ALL Allstate. So it's got lots of volume, 2 stars liquidity for options, price is $130, not in a squeeze, gave me 3 dots, green candle low, red candle higher, single bar reversals. The short-term and long-term bongo are both bullish. That's great. I really like it when the short-term bongo just turned bullish. High jump of 30 says it's not extended. So let's take a look at Allstate. So on the right is a weekly chart, and we could see, like the rest of the market, it's gotten choppy starting in the middle of 2021. But notice that unlike the indexes that are living down here, this is still close to its prior highs. If I look over here on the left at the daily chart, yes, there's still some overhead supply. And I like trend lines, and I like trend line breakouts, so I'd probably stick a trend line on this. So let's just stick it up here, and let's stick it down here. So we are coming up to trend line resistance. So I might be concerned that the market's bearish. I probably wouldn't be taking the trade right here, but I might be looking at this stock to break this trend line, and a break of this trend line might trigger some interest in the stock. Now, if you think about where the stock closed at 126, the trend lines Going to be in the 130, 131. So it's about 3% away. But a break above this trend line would be very interesting. And notice that we had a lot of volume, we had a breakout, and we had a momentum signal. So Allstate looks like something I might want to follow. And down here, and these are everything here is free except for the second and third time frame and the EMS signal. So built in to, and I'll go into that chart right now. This chart here is a chart that is included within the Wealth Charts platform as far as the indicators. So anybody that buys the Wealth Charts will get what's on this chart. And if I just put up Allstate, you can see there's the trend line that I need to get above. There is the three dots. This is a PSAR green. Daily bond goes green. And then I could have added, but I don't think I have them here. Let me just check real quick because I wanted a clean chart. Yeah, that wouldn't confuse people. Down here, I've got the high-low jump, which is part of the marketplace package, but this is just a relative strength versus the S&P, and this is OBV versus a moving average. So I'm about to break above a downtrending trend line on volume and momentum with a breakout signal with good relative strength and volume. This is one that will go on my watch list, but I probably wouldn't buy this unless it got above that trend line. ACC, I believe, is a buyout, so we don't really care about buyouts, and that's because we messed this up here. All right, SIGA, monkeypox story. Now, one of my presentations in the Orange County meeting was stocks patterns you don't want to buy, and this is one of them. If you look at the volume on something like this, the volume gets just plain old silly. So let's see if we put up the data window. Down here, let's find the regular volume. Here's the volume. So we go back here and just watch this volume window as I move forward. 84,000. Here is 230. Here's 394, 146, 110. No one cares about SIGA Technologies. Now look at the volume. 72 million. 26 million, 14 million, 7 million. Now everybody cares about SIGA technology. Well, what happened? Did they just discover the cure for cancer? No. They are a company associated with the diagnosis of monkeypox. So if you believe that monkeypox is the next COVID and everybody's going to get it, even though they're not the vaccine that people are using, they're not the therapeutic, they're developing these things, then SIGA Technologies could go to the moon. Or is this going to be like Lakeland Industries, Alpha Protech, Plug multiple times, although it's a real stock today, where they run up on retail buying frenzy, and then once the story's done, they go back to baseline, in this case, which will be $6 or $7 stock. Be careful if you're in this. It can go a lot higher, but I bet you a year from now it's back to $6 or $7. Another one that I like that's really got one of the most perfect patterns in the market today is Sun Optica, STKL. Again, 1.3 million shares, 2-star liquidity, relatively cheap stock at $8.35. 3 bullish dots. Bongo daily, weekly are up. 77% of the high jump, so it's starting to get extended, but then I look at the pattern and it's just broken above the 200. I don't pay attention to the number. And why is this one of the best looking stocks? Because you had a cup, a handle, and a breakout. Somewhere in there I could convince you of that. But more importantly, the 50 is now broken above the 200. The 17 is broken above the 50 and above the 200. The stock is above all of them. And on Friday, you had big volume breakout and momentum. Relative strength and OBV look great. It just came out of a squeeze. I think STKL is one of the better looking stocks in the market. And yes, it's in a long-term downtrend. But this was a big time down here in March when you had a long-term reversal. I think that this looks good. It's not an energy company. It's a I think, consumer staple company. Looking at the rest of the list, some of the things that I looked at this weekend that I thought looked interesting. I'm not really into buying banks right now, and this is certainly a bottom fishing play, but if you're looking for a regional bank that had some momentum to the upside, enough to give you a daily bond goes green, you got UMPQ, again, the same momentum breakout and volume with the PSAR supportive. Then you have to ask your question is how much do you want to be in some of these staples that have had big runs? What's new in soup? I don't know if anything's new in soup, but Campbell Soup has run from October of 21 with the lows down in the high 30s up to 46, has a 3% or so dividend. It's off its highs, but it's got a nice pattern here above the 50. I saw a lot of that, think like Hershey and Kellogg and things like that. Coke is another consumer staple that looks interesting here. So when Coke, McDonald's, Campbell Soup, Kellogg, Hershey are starting to lead the market, that tells you it's a time to be defensive. And then another thing I thought looked interesting, IEF. IEF is a 7 to 10 year treasuries. If interest rates come down, this is likely to go higher. I don't know if interest rates long term are going to go down as the Fed keeps raising. But if the economy starts to slow down, I think bonds are a good place to be. And so I actually started nibbling on IEF last week. So where do I want to end? If you want to play the market, and I am betting that this market is going to go lower, although do we get a holiday bounce? I do want to look at some of the seasonality in a second. But if this market starts to go down, remember these things called the contra ETFs. These are instruments that you trade long, but are inverse of the index underneath. So if the index goes up, they go down. If the index goes down, they go up. So if you look at them, the only one on the week that was down was the VIX, and that's because the VIX went down. So an ETF that goes up when the VIX goes down is going to go down as well. So let's just look at, for example, SOXS. This is a leveraged ETF tied to semiconductors. Remember I said semiconductors, the SOX was down 9.6 this week? Well, on the weekly chart, this puppy was up 33%. So if you believe something is going to fall, you can find the corresponding ETF that goes up. So the dog goes up when the Dow goes down. Dow had a down week, dog was up. Dust goes up when gold goes down. SARC goes up when the ARCs go down. SDS and SPXS with different amounts of leverage go up when the S&P 500 goes down. SQQQ goes up leverage when the Qs go down. So Qs have been tough. SQQQ is kind of doubled. TZA goes up when small caps go down. And there's pairs. Like TZA has a thing called TNA. If the markets are going up, TNA goes up and TZA goes down. If the markets are going down, TZA goes up and TNA goes down. Learn your contra ETFs. They're great ways of playing short-term markets to the downside. Now, why haven't I gone into a big bearish diatribe and looked at all these stocks to short? Because I think it's a dangerous time to short. I found plenty of stocks to short this week, okay? There was no shortage of stocks that look like they can go lower. These were some of the ones, that's not what I wanted. I want the short list, which is this one. And many of these are technology stocks. For example, Qualcomm. Why would I even consider shorting this again? Because it ran back up into its moving averages and it's breaking down. If I plotted, and I love trend lines, because trend lines, well, they work, frankly. If I plot a trend line on this, somewhere around like this, I'm in a downtrend. And when I'm in a downtrend, I like to sell it off of resistance and buy it off of support. So I'm short Qualcomm right now. We'll see if it comes down and bounces. So I like to look at trend lines. Um, let's see, ASML, one of those expensive semiconductors, it's fallen a long way. Now, would I short it now? No. Wait for it to run up into the 50. I love to short when it runs into the moving averages if I'm going to short individual stocks. Frankly, I prefer, as those have been here before, I prefer the contra ETFs. Texas Instruments pulled into the moving average and broke down. So there are things out there to the downside, but this has got me a little bit cautious on the shorting. If we look at over the next 8 weeks and we look at seasonality for 10 years and we look at the S&P sectors, 1, 2, 3, 4, 5, 6, 7, 8 of them are positive over the next 8 weeks. 2 of them will not make this list, whether they're positive or negative, because 2 of them, real estate and communications, did not exist for 10 years, and only 1 is bearish. And the only one that is bearish, and you probably can figure out what's bearish. Remember I said energy seasonality is going the wrong way. So you got a very strong seasonal period of the market. Over the next 8 weeks, the spider is up 3.55%. Here is technology, for example, from July 6th, which would be Wednesday, and that's because the first day of the trading week in 2021, which I'm just using to measure, was the 6th to the end of August. XLK is up 9 out of 10 times, average return 5.29, maximum loss was 2.34, and you could see how technology has done over time. You could look at things like Apple, whose chart may not look really attractive to go long right now unless you like buying cheap and hoping. Apple's actually up 9 out of the next 10 weeks. 9 out of the next 10 has been up 9 out of the last 10 years, an average of 9.34% in this 2-month period. But boy, the down year was a pretty big down year. So my message to you is this is an interesting time. There is some seasonality that's strong. Don't buy Apple just because seasonality is strong. If you get a technical setup in Apple, might be a good time to be nibbling as it gets cheaper and cheaper. But the technicals right now are not exactly your friend. In fact, we're just going to go look at Apple and then we're going to close. And Apple is just, does that look like what you want to be buying? You're seeing all the green in here? No. Maybe, you could probably, remember me, the trend line guy, probably stick something up here at that high and look for the prior high to where we are now, which would have been about here. And a break above that line, that might be bullish. But what's more likely to happen? How many times has this trend line been hit and failed? Yeah, shorting opportunity is my guess. Hey guys, it's July 4th. Thank you again, as I've said on Memorial Day, to those who served, those whose families have supported those who have served, and to the families of those who gave the ultimate sacrifice in protecting our freedoms, our rights, our ability to say whatever we want to say on a webinar and not worry about somebody coming and get you, except if I promise you great returns that are not real. So we don't do that on these webinars. You all have an awesome, awesome week. Just because seasonality is strong doesn't mean the market can't continue going down. See y'all on Wednesday morning. And just before I go, don't forget, during the week, you'll get short videos at stocksanddocs.com. In fact, I'm going to go record one when I get done with this. I'll cut this hour-long video down to 10 minutes. And then the other thing I wanted to point out was, don't forget, please come to Wealth Charts, the Wealth 365 event. And here is the URL, and I'll put this underneath the video on the YouTube site. You all have an awesome week. This was an hour almost exactly. Take care.